Welcome to our introduction into advanced auditing and insurance services. In this presentation, I'm going to provide a brief overview of the material that we're going to be covering. And this is very important because it provides the framework for our continued discussion throughout this semester. Keep in mind that when we consider auditing, auditing is very different than many of the other courses that you have taken. We're not really doing techniques, we're not doing computations, we're not preparing and analyzing financial statement, but we are looking at financial information. We're looking at it from an analytical perspective, we're using logical skills, and as we're going through the audit, one of the critical things that becomes paramount is the fact that what we need to have is critical thinking skills. So again, very different than the kind of classes that you've taken in the past. Before we begin, we need to understand the context of the audit. And the best way to understand the context of the audit is to consider it from the perspective of the agency theory. The agency theory essentially explains the fact that there are two groups within an organization. There are the principals. The principals are stockholders or owners of the corporations. And then there are the agents. Agents are represented by management. Agents have their own self-interest, principals have their own self-interest, but it's through the audit that information is communicated from managers to the principals of the organization in terms of determining what is actually taking place. So what you see here is the principals, or the owners of the corporation, are interested in understanding what is actually taking place within the organization. The primary means of communicating what's taking place is through the financial statements. However, there is a general distrust between principals and agents, and the reason there's this distrust is because agents have their own self-interest. So here comes the auditor. The auditor provides an objective, independent opinion of the financial statement information. The auditor is not telling the principals that management is doing a good job or not doing a good job. What the auditor is saying is when you look at the financial statement information, the information is presented fairly, and then the principals are able to look at this information and make determinations as to whether or not management is doing the appropriate job. So again, our role as the auditor is part of this communication, and part of this communication is that what we're doing is we are providing an objective, independent, professional, skilled opinion of the fair presentation of the financial statements. The role of the auditor is looking at what management is doing. One of the critical things to understand is that management is responsible for the financial statements. Embedded in these financial statements are what we call management assertions. Now take a very close look at these management assertions. We're going to continue these throughout the course. It's very important to understand that what we're looking at is we're looking at what management is saying. Assertions are implied or explicit statements embedded in the financial statements related to transactions, related to account balances, and related to presentation and disclosure. Again, we're going to spend a tremendous amount of time talking about this because frankly, this is the basis of the audit. Let's understand briefly where the audit fits in to the overall assurance services provided by a CPA, provided by an audit firm. You notice we have a circle within a circle. So auditing is a very specific process. The audit is where we are expressing an opinion based upon our assessment of a subject matter. Audit is also an attestation. Attestations are not audits, but audit is an attestation. Auditing also provides assurance services. But we'll understand each of these elements as we go through the course. The one point that I do want to make is that during most of this course, is we are talking about auditing from a financial statement audit perspective. Keep in mind that there is also another audit that we talk about. This audit is the audit of internal controls over financial reporting. We'll talk about that in chapters 7 and 8, but one of the things that we do need to understand is that in most of our discussion, when we talk about audit, we're talking about auditing from the perspective of auditing the financial statements. So the official definition of auditing is that it is a systematic process of objectively obtaining and evaluating evidence regarding assertions, so you notice the assertion word here, about economic actions and events. These economic actions and events are the transactions that the organization goes through during the course of the year. To ascertain a degree of correspondence between those assertions and established criteria. The established criteria is the generally accepted accounting principles, and then we're communicating these results to interested users. Our communication is through the audit opinion letter, and we're going to be talking about that, and the interested users are going to be the principals, the stockholders, and other stakeholders within the organization. Assurance services, which we will actually talk about later on in the course, is an attestation service where a practitioner, a CPA, is engaged to issue a report on a subject matter or an assertion about a subject matter. That is the responsibility of another party. We're not going to talk about that now. We're going to defer that discussion later on in the course. And then finally, assurance services, an independent review of professional services to improve the quality of information in its context for decision makers. Assurance services are beyond the scope of what we're going to be talking about in this course, but we will mention it as we start talking about things other than the audit of the financial statements and the audit of internal controls over financial reporting. Let's understand the overview of the financial statement audit process. And again, what we are considering is what actually takes place in regards to the audit of the financial statements. Keep in mind that management is responsible for internal controls. We'll be talking about that. They're responsible for conducting transactions. They're responsible for accumulating account balances and transactions, preparing the financial statements. Keep in mind, management is responsible for the financial statements. The auditor, once we've defined our terms of engagement, we consider evidence. We consider evidence as it relates to the assertions of management and how these stand up against the criteria of our GAAP principles. We determine the overall fairness of the presentation. So you notice that we're not saying that the financial statements are exact. The key word that we're going to use is presented fairly. So the idea is we're not looking for perfection. We're looking for a level of fairness, and we're going to be using the term materiality. Then we issue the audit report, and the audit report becomes a part of the financial statements so that when the financial statements are issued, they're issued as audited financial statements. Three key concepts that we need to understand. And we're going to just very briefly touch on these because a lot of the material that we're going to be covering over the next couple of weeks are going to go into a deep dive related to these. The three items are audit risk, materiality, and evidence. So let's talk about materiality first. Materiality is information. Information is material if omitting it or misstating it could influence the decision that a user makes based on the basis of the financial information. So essentially what we're saying is we are providing evidence. We're assessing evidence in regards to, are there material misstatements? Now there may be misstatements, but as long as they're not material, we're going to be able to express an opinion that the financial statements are fairly presented. And again, the definition of materiality is how much of this information is, if it's missing, would change the decision of a user of this financial statement information. Audit risk is very interesting and actually very important as we are considering the audit. You notice that audit risk is the risk that the auditor expresses an inappropriate opinion. So what we're saying here is that the auditor does not want to be wrong. The auditor wants to express an appropriate opinion. However, the auditor needs to understand that there is risk in regards to the expression of his or her opinion. So the key word is that the audit standards require that the auditor provide reasonable assurances that the financial statements do not contain material misstatements. Reasonable assurance implies that some risk of a material misstatement could be present in the financial statements, and the auditor will fail to detect this. One of the interesting concepts related to audit risk is understand that auditing is a for-profit business. And what we mean by this is the auditor doesn't have unlimited time, doesn't have unlimited resources to complete the audit. So the auditor is looking at imperfect information. So what we're looking for, the threshold that we have in regards to our opinion, is this concept of reasonable assurance. The last concept that we'll be talking about is related to evidence. Evidence is, frankly, everything that the auditor gains in understanding related to evaluating management's financial statements, the assertions, and it consists of underlying data, any information, other information that will be available to the auditor, whether originating from the client or externally. And again, we're going to be spending a tremendous amount of time talking about this, and as all we're doing here is just providing the introduction. Key words related to evidence. Relevance is the information related to the specific assertion. So you notice the relevance relates to the assertion. Reliability, can the information be relied upon to signal the true state of the specific assertion? So reliability, critical. And keep in mind that as we're considering reliability, we're not looking for absolute reliability. What we're looking for is being persuaded that the information is in fact appropriate, and it gives us the ability to provide this reasonable assurance. The last piece that we want to talk about is sampling. We're going to be spending some very specific time talking about sampling. Auditors use a sampling approach to examine a subset of transactions. Critical in terms of understanding the scope of what our services are is it would be too costly for the auditor to examine every transaction, but at the same time, we need to understand that sampling creates risk. We're not looking at absolutely everything. We're looking at a subset. So the way we pick our sample is going to be critical. How much we actually look at is going to be critical. And the sampling technique will, in fact, impact our audit risk. Major phases of the audit, we'll be talking about this throughout the course. Client acceptance. We need to understand that there are some very specific things that we need to do in regards to the client acceptance. We have preliminary engagement activities. This includes planning the audit, considering the audit or the audit internal control framework. And then we're going to do the audit of business processes and related accounts. You notice that we've already talked about this concept of management assertions. Now we're also going to overlay this from the perspective that we are breaking up the audit in regards to business processes. Business processes include things such as revenue, the purchasing cycle, and a couple of other cycles that we'll consider. We complete the audit, evaluate the results, and ultimately issue the audit report. I have an audit report here, and frankly, it's very important for you to understand the various components of this. And in fact, when I went to school, one of the things that the professor strongly recommended that we do is that we memorize the audit and understand every component related to this. Now, a couple things to keep in mind is that the title in this case is the report of the independent registered public accounting firm. Keep in mind that this is an audit report for a publicly traded company, and these standards, these audit standards, are actually coming from the Public Company Accounting Oversight Board, part of Sarbanes-Oxley, which we'll talk about later. But you notice also that the address is to the stockholders of Earthware Clothiers. So this is the company, but it's going to the stockholders. Why is this important? Well, it's going to the stockholders because the auditor is not engaged by management. The auditor is engaged by the principals, usually through the audit committee or the board of directors, depending upon the size of the organization. There are 3 primary paragraphs, and then there's finally an explanatory paragraph that we'll just defer to a later discussion. But I want to focus on these first 3 paragraphs. In the introductory paragraph, what we're identifying is what we are auditing. So you notice that we are auditing the statement of operations, auditing the stockholder equity, cash flow, as well as the income statement for the period ending December 31st, 2013. The audit of the financial statements is the audit of the complete financial statements. We do not do an audit of the balance sheet or an audit of the income statement. We're doing an audit of the financial statements. It includes all of the financial statements. The key phrase next is that these financial statements are the responsibility of the company's management. Management is responsible for the financial statements. Our responsibility is to express an opinion of these financial statements based upon our audit. So what is our responsibility? To express an opinion. What is our opinion based upon? Based upon our audit. In the scope paragraph, we first identify the standards that we're using. So we're using the standards, in this case, of the Public Company Accounting Oversight Board. These standards require that we plan and perform the audit, and notice the key word here, the key phrase, to obtain reasonable assurance about whether the financial statements are free of material misstatement. Key word, reasonable assurance and free of material misstatement. An audit includes examination on a test basis. Key phrase, on a test basis, tells explicitly the user of the financial statements that our opinion is based upon a sample of the complete population. This includes evidence supporting the amounts and disclosures in the financial statement. An audit also includes assessing the accounting principles and significant estimates made by management, as well as the overall financial presentation. We believe our audit provides a reasonable basis for our opinion. And here's the opinion. This is what a company pays for when they're getting an audit. In our opinion, the consolidated financial statements referred to above present fairly, in all material respects, the financial position of the company as of December 31st, 2013 and 2014, and the results of its operation and cash flow in conformity with U.S. generally accepted accounting principles. This is what we're calling an unqualified opinion. The unqualified opinion implies that we are expressing this opinion without qualifications. We'll talk just very briefly about this in the next slide, but the point that we want to make here is that this is an unqualified opinion, a clean opinion, where we are expressing our opinion that the financial statements present fairly, in all material respects, the financial position of the organization. The name of the auditor is here. And one of the interesting things is that the only person that can sign an audit report is a CPA. And then finally, we have the date of the audit. We'll discuss this later on. The date of the audit actually is very important in the flow of understanding what's taking place within this complete audit cycle. So there are three types of opinions. We have the unqualified opinion. The unqualified opinion is where we are expressing an unqualified opinion. In other words, we are expressing an opinion that the presentation of the financial statements present fairly in all material respects. This is an unqualified opinion. A qualified opinion essentially is where we are expressing a qualification to our fair presentation. So in a qualified opinion, we may say something to the effect that the financial statements present fairly in all material respects except for, and then we will express our qualification to our fair presentation opinion. An adverse opinion is one where we are saying that the financial statements do not present fairly. Okay, so we have in this short session provided a brief overview of auditing. We are going to go into much more detail in regards to each of these aspects. But the point that we want to have here is that we are, in fact, going through a journey that I think will be very interesting as we're going through this. What we're going to be covering is all the critical aspects in regards to the flow of the audit that we've been talking about today. So I thank you very much for your time, and I'm looking forward to talking to you soon. Thank you.